Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glenn Sutherland. This week, my guest is Taha Khan. Hopefully I said that right. But Taha, if you want to start off by just giving everybody a bit of an introduction to yourself.
Sure. Thank you, Glenn. Pleasure to be here. So my name is Talha Khan. I am with Nexus Accountants and Advisors. It's a small firm down here in South Florida, and we specifically focus on U.S., international, and cross-border tax. Majority of my clients are Canadians. I would say about 80% of my clients are Canadians. We do individual and corporate work. Anything that has to do with, U.S. residents with investments abroad, or U.S. citizens that, live overseas, for example, in Canada, that, still have a U.S. tax filing obligation. We can assist them with, the U.S. tax compliance, the Canadian tax compliance. We have a lot of clients who are departing Canada. Departure tax planning, pre-move planning. We're able to assist anything that's basically domestic or cross-border related. We're here to help.
That's awesome.
Yeah.
There's so many things we could talk about. But what we were thinking about talking about was the substantial presence test. So if you want to start off by just telling us like what it is and like why is it important? What should people even be concerned about this at all?
Right. So basically, it's extremely important for snowbirds. Canadians like to come down here in Florida, spend their winters here.
Yep.
And what's really important is that, a substantial presence test consists of 183 days, right? That 183 number is extremely important because for U.S. tax purposes, if based on the substantial presence test formula, which I'll get into in a little bit, you meet the 183. Okay, so what the substantial test formula is that it consists of 3 years. Your current year, so for example, if we're in the 2024 tax year right now, it picks up 100% of the days in 2024, a third of the days in 2023, and a sixth of the days in 2022. If the total of those 3 years you hit 183 or more, at that point you could be considered a U.S. tax resident for U.S. tax purposes. How you can avoid filing and becoming a U.S. taxpayer is that you can file what's called a closer connection form to let the IRS know that, hey, I'm just here, I'm only a snowbird. My closer ties are to Canada. My family's in Canada. My center vital of interest is in Canada. My business is in Canada. I'm only here in the U.S. for vacation purposes. As long as you get that filed by June 15th each year, you meet the substantial presence test, you're still considered a non-resident. However, if you mistakenly spend 183 days in one current tax year, so for example, in 2024, you spent 183 days in Florida, then at that point, you no longer qualify for a substantial presence, a closer connection filing, because the IRS is going to say, well, you exceeded the second bullet point here, which is you cannot spend more than 183 in one current year. So, the U.S. and Canada has a really good tax treaty where you can still avoid being taxed as a U.S. resident, but you do have a U.S. tax filing obligation. You can file a non-resident return, taking a treaty position where, if there's any U.S. source income, you report that on your return. But other than that, there's still a lot of, foreign financial asset reporting and international disclosure forms that are required with their U.S. filings. These forms have a penalty of a minimum of $10,000 per form per year. So extremely important that you track your days because it could lead to you being a U.S. resident for tax purposes. And, you have all these filing requirements that you have no idea of.
Yeah, I always thought it was just in the specific year that you're in, like, so that just to keep under the, like, a little bit rougher math, but
yeah, so right. So it's really important to track your days every time you're in the U.S. because you never know, right? Especially during COVID, where people were stuck, they couldn't cross the border.
Yeah,
everybody was meeting the substantial presence test. So, the IRS came out and said, we're gonna put an exemption on this. That if you're here for medical purposes, and that this was only during 2020 to 2023, that if you're here for medical purposes or you can't go back because of COVID, you can exempt your days, right? If you're here on an F1 visa, you can exempt your days. But if you're here on a tourist visa like a B1, B2, then you can't exempt your days. You can only spend less than 183 in the current year or less than 183 based on the substantial presence test. There's a really nice article I put together on my website. If you go to www.nexus.tax, that's nexus.tax, and you go to the blog section, there's a really nice article where I break down the formula, break down the exceptions, and how it works.
Yeah, and in my head, I'm going, okay, so is this just meaning that you have to file taxes, or is it saying that you said tax resident? So does that mean that your principal taxes are in the US? So would this I guess there's all these tax trees, but would this lead to any sort of double taxation where, Canada might consider you a tax resident and the US might consider you a tax? Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
Right. So double taxation definitely comes into play where it's not a treaty country. However, because the US and Canada has a really, really good and efficient, tax treaty, you can take advantage and you can avoid double taxation. It doesn't mean that, you don't pick up the income on either side of the border. You have to pick up, US taxes you on your worldwide income, Canada taxes you on your worldwide income. So you report everything you have worldwide. You may have a Canadian corporation. Now, there's a very strict filing requirement in the US where if a US tax resident has a foreign corporation, they're required to disclose that on a form 5471. It's a very complex form. The penalties, again, are 10,000 per form per year. You can take the treaty position and you can avoid the double taxation, but the reporting of this foreign corporation, foreign bank accounts, for example, the FBAR, these still exist, right? There is some workaround around some of these filings. There's some exceptions we can use. There's some court cases that we can potentially look at. But, to avoid all of that, it's extremely important that you track your days and you try to stay here less than 183. And, if you have no choice, you may have kids here and you want to spend 200 days here, sure, you can do that. But just know that you have some non-resident tax filings here that you need to abide by.
Okay. So I don't know if I'm overcomplicating this, but for myself, I have an E2 visa and I could just go live in the United States. So I'm already filing tax returns with personal and corporate tax returns with the IRS first, and then with Canada Revenue second. Would this have really any impact on somebody like me?
No, because you're already filing a U.S. tax return.
Uh-huh.
I'm assuming you're filing a resident return. But I'm not sure how many days you're spending, but
Yeah.
yeah.
Okay. I was just curious about it because I know that one thing too is if you're gonna stay down in the totally off topic, but if you're gonna stay in the U.S. for I think over half of the year, you start getting into a thing where some of your healthcare and certain things
Absolutely. Right,
get yourself in trouble. You might be losing your benefits in Canada.
Right, exactly, right. So, if you have an off year where you accidentally become a US resident because you met the 183-day test, that's okay. You can file the returns for that 1 year and you don't have to file every year if you don't meet the test. This is only for the year where you meet the test or you exceed the 183 in a current year. But what's also important is that depending on which state you're in, for example, California doesn't accept the federal tax treaty. So, if you spent over 183 in California, you're a resident for California state purposes. You have to report your worldwide income, and California will tax you twice because there is no tax credit there that you can pick up. New York is another state. Florida, obviously, we don't have income tax on the individual level, so you're okay in Florida. But you really got to be careful, especially in those tricky states.
Yeah, it's something to think about if you're if you had some intention of staying in the US for a longer period of time. And I think it's a lot of times we just don't even think about it. And And even just hearing you talk about it, it makes me realize that if I was going to do that, I would be wanting to talk to a CPA while I was, just to understand what consequences I was going to have. Because it's not one of those, it doesn't sound, when you keep saying $10,000, it doesn't sound like one of those
Yeah,
things you want to wait and figure it out after.
yeah, really, the minimum penalty every time you look at a form starts at 10,000. And it could be up to 50% of the value of the asset or the financial account, whatever the case may be. But yeah, the penalties, and I've seen some penalties, right? Where you just don't want to get into that. You want to make sure you're compliant. And if you have a tax filing obligation here, you have to obtain a US tax ID number, it's, referred to as an ITIN.
Yeah.
So there's a lot of filing requirements on this end.
Yeah. So, with your business, you guys, we're kind of talking about more of like living in the US, and we weren't really talking about like on the investor side. Do you guys work with investors or Canadian?
Yeah, absolutely. Yeah. We have a lot of Canadian clients that may have a rental property that's owned, by their Canadian corporation, right? So you have the US tax filing obligations for that foreign corporation, or you may just have a Canadian that has interest in a US partnership, to where we can file a non-resident return and report that interest in a partnership. But yeah, we have clients in Canada, UK, France, a lot of French Canadians. We're sort of all over. I mean, there's a lot that we can obviously get into, but some of the main things that I see here for Snowbirds is they may have a vacation home, and when a non-resident or a foreigner sells a U.S. real estate, they're subject to what's called a FIRPTA withholding, which is a 15% withholding on the gross sales price. So, a lot of our foreign clients aren't aware of that. So when they go to sell the house, they're like, oh, well, you're not a U.S. person. Now you have to withhold 15%. There's a set of IRS forms you have to submit. You have to get a tax ID number. Then the following year, you have to file a non-resident return to report the sale of the property. Unfortunately, a lot of Canadians aren't aware of that. Or, not only Canadians, but basically foreigners aren't aware of that. So, it comes to a surprise. You have, filing fees, preparation fees that you're not accounting for. There's also an article I put out about this on my website. So if you want to take a look, kind of get familiar with it, something really important to be mindful of.
No, I totally agree. I was because I Canadian investing in the U.S. and I was talking with my parents' neighbors, and they were like, "I'll never invest in the U.S. or never buy in the U.S. again." When we went to sell our property, they put a 15% tax on it, and I was like, "Yeah, so?" I'm like, file your taxes and you'll get it back, or they'll just take the correct amount. I have more free content, so if you're interested, I created a PDF guide and a video to go along with the PDF guide to complement it. And what the guide is all about is the 5 most common mistakes that Canadians make when investing in the United States. So if you're interested in this free guide, go to CanadianInvestingInTheUSA.com/mistakes. And let's go back to the podcast. And it's free.
Yeah, that 15% isn't a tax. It's just a withholding. So the IRS came out with this, I think it was 1987 or 1989, where non-residents would sell a property and, it's U.S. source income. You're supposed to file a return.
Yeah.
Foreigners wouldn't file a return. So the IRS said, you know what? We're going to hold back 15% on the gross price. They can get it. They can claim that as a credit when they file their return. In a lot of the cases, you may not have a capital gain, right? Because, you spent a lot of money on the property, your cost basis, allows you to not have a capital gains. So, so you just get that full 15% back on your tax return. So really, it's just a filing obligation. There may not even be any tax owed, but, it's something definitely you need to keep an eye out on.
Yeah, I usually suggest to just own it in an entity and just forget about that whole thing. Get an American entity and own the property in that, and not have to worry about FIRPTA.
But the thing is, owning it in an entity has its own filing requirements, right? If it's it's a U.S. domestic corporation owned by husband and wife in Canada. Now it's a foreign-owned, disregarded entity. You have to file a return every year. Any expenses that you pay for that property have to be reported on a special form called Form 5472 for a related party transaction. That penalty is not $10,000; it's actually $25,000 per form. So, no matter how you structure it, there's always going to be something. Just extremely important to consult with your advisor. It's important that you have an advisor that knows international tax. because these penalties, a lot of the times it's automatic, where the IRS, once they assess that penalty, it's very, very difficult to get it abated if, you can.
Yeah. Yeah. Oh, I love it. Talon, that was great. I think there was a lot of information in there. I think some people are going to take some good takeaways. If people wanted to get a hold of you to get some advice or work with you, maybe to do some, you listed a whole pile of different things you do at the start. If they wanted to get a hold of you to do that, how do they find you? You have an email or website or
For
where do
sure.
they find us?
Yeah, my website is www.nexus.tax. That's nexus.tax. And my email address is tkhan, that's tkhan @nexus.tax. Either way, you can submit an info request on my website or you can email me directly. My phone number is 305-396-8089. They can call me, that's my direct line, and they can reach me there.
Awesome. Well, thank you for coming on the show. I really appreciate it.
I really appreciate you having me.
That was a nice video. Bye.